The proposed changes aim to address the growing wealth gap and reduce the tax burden on low and middle-income households. The proposed capital gains tax changes. Overview of the proposed changes. The proposed capital gains tax changes are designed to address the growing wealth gap in the United States. The current tax system favors high-income earners, who often hold more assets and generate more capital gains. The proposed changes aim to reduce the tax burden on low and middle-income households, who are disproportionately affected by the current system. The proposed changes would plus increase the tax rate on long-term capital gains for high-income earners, plus introduce a new tax rate for high-income earners on certain types of investments, plus limit the amount of capital gains that can be offset against other income. Addressing the wealth gap. The proposed changes are designed to address the growing wealth gap in the United States. The CRA's new inclusion rate, a shift in taxation. The Canada Revenue Agency, CRA, has announced a significant change to its inclusion rate, which will impact how tax returns are processed and refunds are issued. The new inclusion rate, effective June 25, 2024, will alter the way the CRA calculates the amount of tax owed by individuals and businesses. Understanding the current inclusion rate. The current inclusion rate is 75% of the tax owed, with the remaining 25% being withheld from the taxpayer's account. This means that if a taxpayer owes $100 in taxes, the CRA will withhold $25 and the taxpayer will be responsible for paying the remaining $75. The new inclusion rate, a shift towards greater transparency. The new inclusion rate will be 80% of the tax owed, with the remaining 20% being withheld from the taxpayer's account. This change aims to increase transparency and reduce the risk of tax evasion by making it more difficult for taxpayers to hide income. Taxpayers face uncertainty and complexity due to the CRA's policy and the capital gains tax hike. The CRA's tax filing policy, a complex issue. The Canada Revenue Agency, CRA, has a long-standing policy of asking taxpayers to file their taxes based on proposed tax legislation. This policy has been in place for decades, with the CRA relying on the proposed tax rates and rules to guide taxpayers in preparing their tax returns. However, critics have argued that this approach is less sound when applied to the capital gains tax hike, given the uncertainty stemming from Parliament's prorogation. The capital gains tax hike, a complex issue. The capital gains tax hike is a significant change to the tax system, with proposed rates ranging from 10% to 33%. The hike is intended to address income inequality and generate revenue for the government. However, the uncertainty surrounding the hike's implementation has raised concerns among taxpayers. Key concerns. The CRA's policy of asking taxpayers to file their taxes based on proposed tax legislation may not accurately reflect the final tax rates and rules. The uncertainty surrounding the capital gains tax hike may lead to confusion and errors in tax returns. Taxpayers may be required to pay more taxes than they would have under the original tax rates. ###The impact on taxpayers *. The impact on taxpayers. The CRA's policy of asking taxpayers to file their taxes based on proposed tax legislation may have a significant impact on taxpayers. Some of the key concerns include increased complexity. The uncertainty surrounding the capital gains tax hike may lead to increased complexity in tax returns, making it more difficult for taxpayers to prepare their returns accurately. Potential for errors. The CRA's policy may lead to errors in tax returns, resulting in taxpayers owing more taxes than they would have under the original tax rates. The backlash against the new inclusion rate. The introduction of a new inclusion rate has sparked a significant backlash from various stakeholders, including individuals, organizations, and businesses. This backlash is not surprising, given the significant changes that the new rate brings to the way we think about and measure inclusion. The concerns of business leaders are among the most vocal critics of the new inclusion rate. They argue that the rate is too high and will lead to increased costs and decreased competitiveness. For example, a CEO of a large corporation told Drover that the new rate will require them to hire more employees with disabilities, which will increase their labor costs and make it harder to compete with other companies. Some of the concerns raised by business leaders include plus increased labor costs plus decreased competitiveness plus difficulty in finding qualified candidates plus potential impact on company culture. The concerns of individuals with disabilities. On the other hand, individuals with disabilities are also expressing concerns about the new inclusion rate. They argue that the rate is too low and will not provide them with the level of support and accommodations they need to fully participate in society. Some of the concerns raised by individuals with disabilities include plus lack of support and accommodations plus limited access to education and employment opportunities plus stigma and discrimination plus inadequate resources and funding. The response of advocacy groups. Advocacy groups are responding to the backlash against the new inclusion rate by emphasizing the importance of inclusion and the benefits it brings to society.